So there's a couple of things that we need to be really sure of when we do a WACC analysis. What we're looking for is that we want to make sure that there is consistency between the components of WACC and of free cash flow. And so what that means is that we want to make sure that we're going to include in our WACC the opportunity cost, or the cost to all the firm's investors. And so that means that even though we just looked at the simplest form of WACC, which is just debt and equity, any other investor in the firm, any other provider of capital, also needs to be included in the WACC formulation. So the most common other provider of capital is preferred shares. So we might have a term in there for the market value of preferred shares divided by the market value of the firm times the cost of preferred shares, right? So we just add a third term. And we can add a fourth or a fifth or a sixth term. And all we're trying to do is understand where all the money comes from and make sure that we are discounting the free cash flows according to the risk undertaken by all the investors. And this is important because free cash flows are provided back to all of our outstanding investors, right? We're using free cash flows to pay off our debt, to pay our dividends, to provide value for the firm, to buy off any kind of, get a little lost there, but we're using the free cash flows to pay off any of our other investors. So that means that we need to include them when we think about the cost of capital broadly for the firm. Now, the next thing we've got to be careful about is that we make sure that we weight all of the different securities required return by their target market value based weight and not by their historical book values. Now, this shouldn't be an unusual requirement. Certainly you've talked about this in your other finance classes, that there's a big difference between market values and book values. And it's mostly important on the debt side. It can be just really tempting to go look at the book value of debt, take long-term debt, and use that as the total value of the debt. And it's just not the case. The market values can be significantly different than book values. It's not as tempting in equity because we recognize pretty quickly that the book value of equity has is unrelated in a big way with the market value of equity. And so we just want to be careful. We want to make sure that we are calculating the value of these assets using their market values and using information that we know about what's going on in the market. Then we want to make sure that any of the financing benefits or costs that we've excluded in our calculation, we include here in free cash flow, or we value it separately using an APV model. And so what that means most of the time is, remember that when we calculate NOPLAT, we don't consider interest expense. So I work my way through operating profit, revenue minus operating cost minus depreciation. I calculate an operating tax rate, and then I estimate NOPLAT. Nowhere in there do I remove or use interest expense to reduce my taxable income. And so nowhere in there do I value a significant thing or a significant positive asset for the firm. Asset is probably a bad term. I'm being a little loose there, but there's some significant positive value from paying interest, which is that it reduces the taxes I owe. So that's why in the weighted average cost of capital formula, we use the after-tax cost of debt. That's where I'm bringing in the value of the interest tax shield. I am reducing the firm's cost of raising money by the value of the interest tax shield. And that means the more debt I raise, the bigger that shield will be. Right? So that's what we say when we talk about ignoring financing costs early on in the class. We don't really ignore it. We just put it off and we value it in a separate way, so that we can separately consider the firm's operations, which is free cash flow, NOPLAT, invested capital. That's operations only. And then separately we can value financing, which is what we're doing here when we're talking about the cost of capital. Right? So we just want to make sure that any of these other things like that, and there's a few others, we haven't talked about them in this class. It's not worth going into detail on some of this stuff, but anything else that, any other financing related costs, we value them here when we're talking about cost of capital. And then finally, we want to make sure that we're doing it after taxes, which is why we're using the after-tax cost of debt. Free cash flow is on an after-tax basis. So we want to make sure that we're being consistent with everything that all the considerations that we use when we calculate free cash flow. Like if we've included the inflation rate in our estimates of revenue and things like that, then we want to make sure that we match that in our estimations and valuation of debt and equity. And we want to make sure that when we're talking about, say, debt, we want to make sure that we have matched what's called the duration of the cash flows. So remember that we are projecting, our DCF model, we're projecting 15 years of free cash flows. And then we're, and then we're going to a continuing value, so we're projecting an infinite number of cash flows after that. But we want to make sure that we match the cost of capital to our projected series of cash flows, which means we don't want to look at, say, the cost of the firm raising short-term debt. We want to look at the cost of the firm raising medium to long-term debt, 10 to 20-year notes, rather than, say 3 or 6 months. And the same thing is true for equity in some parts of the valuation model. So these are just the things we want to make sure of. A lot of them are just going to be naturally the way that you've learned to do a weighted average cost of capital. And so they're a little redundant, but a little redundant can be a good thing. It can help us remember what we need to do in the future.